Good morning, ladies and gentlemen, and thank you for joining Pengana's webinar series. My name is Joy Yakub. As a brief introduction, the Pengana International Equity Fund was built around three key aims. They are to make money, protect capital, and minimize volatility. The philosophy has been implemented for over 15 years globally by our Chief Investment Officer, Jordan Svetanovsky, who you'll be hearing from shortly. This approach is applied to our flagship fund, but we also have a managed risk version where we work with a global risk management specialist called Milliman, who further emphasize the focus on downside protection. Today, we are joined by Jeff Giebler, Principal and Head of Investment Solutions at Milliman, to chat a little bit more about this later. It is slightly different to our core fund and is primarily for those that want to smooth out their return profile. We will have time for questions at the end of the session, so please feel free to send your questions through just using the control panel on the right-hand side of your screen. So just to set the scene a little, just on the next slide, equity markets have been a really great place to make money. If you compare it to Australian cash or bonds, they have been very attractive. On average, if you think about it, just over the last 10 years, international shares would have delivered approximately 12% per annum through to the end of 2019. And on the next slide here, we have the MSCI All World Country Index. And if you look at this, leading up to COVID, it was a really great place for investors on average. You would have had your 12% return per annum, but then suddenly a large chunk of that gets wiped out. Now, that could be temporary, perhaps, but it is still painful. I want to address two significant dangers to be aware of. The first one is the tendency for people to make predictions. And the fact that the market was where it was before COVID hit meant that there were more willing buyers than there were sellers. And effectively, that's when people try and predict. So on the next slide, it's not just something that we've seen recently. This is something that has happened historically. And if we date all the way back to 1929, when one of the most renowned economists, and by the way, was an investment advisor to many mutual trusts, Irving Fisher, quoted, "Stock prices have reached what looks like a permanently high plateau." And this now was followed by the devastating collapse in the US stock market, which took almost 25 years to recover. On the next slide, we see now there are these dangers. The first danger is on acting on overconfident predictions. And in a world of unpredictability, the second danger becomes the fact that there are behavioral biases that can often lead us to making these really bad decisions. This is an awesome chart by Carl Richards, and it's one of the classics that I use to explain this exact behavior, which just illustrates this point so well. It's the instinct to buy high and sell low, and possibly doing this until you're pretty much broke. This is a very destructive instinct on your wealth and wealth creation. So now, what we do know for sure is that it is extremely difficult to predict markets, what markets will do. Not only that, but then you have to time it and you have to get it right, all while managing your behavior. So what this strategy aims to do is take the guesswork out of timing the market and mitigate the risk of bad decision making, which is often made by our natural human instinct that often leads to this permanent loss of capital. So with that in mind, I will hand it over to Jordan, who will provide insight on how this is achieved through our portfolio construction, and by Jeff, who will explain a little bit more on how the Milliman risk overlay helps mitigate these risks that we're often faced with. Thanks, Jordan.
Thank you, Joy. Good morning, everyone. It's interesting, the last slide that Joy put up, it reminds me of an anecdote that people often talk about, this behavior that Joy mentioned. And one example that people often use is, for example, the Fidelity Magellan Fund, which is one of the most successful funds that's been around in terms of returns. I think it returns something over 20% per annum. So you think over a period of, I think it was 10, 15 years, that most people that have been invested with the fund manager would have been extremely happy. However, once they've looked into it, they found that the average holder of this strategy lost money. And the reason for that is that due to the volatility of the strategy over that period, people tended to panic when right at the bottom and get excited towards the top. And although over the period the returns were good, that human behavior element that Joy mentioned was the determining factor on how much returns they actually had in the end. So on the next slide, I'd like to mention that I started as an analyst back in the dot-com days, early 2000, and my first experience was witnessing the bubble that preceded the dot-com bust. And I remember being an engineer, how excited everyone was, and that everything was going to go to the stratosphere in terms of returns and what have you. And I was right in the tech sector and looking at these companies. And then I saw what happens when the tide turns, and suddenly everyone thinks, you know, the worst possible scenario. And this is a very powerful force. And that was my first experience in the markets. And since then, we've had 20 years. And as Joy said, for the last 15 years, I've been managing money on a global context. And during that period, I've witnessed several you know, disruptions to the eventual kind of place we're at now, which is after 20 years having the S&P, for example, being up, what is it, 3-4-fold. But during that period, we've had the Twin Towers attack, we've had the GFC, the period preceding the GFC, which is the very low interest rates and ramp up in markets and financials, and then the entire collapse of that system and fear of an entire collapse of the whole financial system, followed by this incredible bull market that has not been witnessed in history, potentially, given the length and the veracity of it. And then we've had this in a period of a month, March and April, we've had the biggest sell-off, or the steepest and most powerful sell-off since the Great Depression in the 30s, followed by the steepest incline, or the steepest rise in the market since the 80s. So these are very, very powerful movements in the market. And the point of all this is to say that it's never a smooth ride, and there's always people telling you it's different this time, you know, things are all going to change, it's going to be worse forever, or it's going to be great forever, as Joy mentioned. But the point is, it's very, very difficult, even after 20 years in the markets, to really say that, to really predict what's going to happen to markets in the 1 year, 2 year, 3 year horizon. What we do know is that equities are a great place to invest. I'm an equities investor, and what that means is that we're essentially giving money to companies to take our money and to invest it in whichever way they know how, whatever they might do, you know, salmon farming, pacemakers, and whatever it is they do, and they keep compounding that over time. And that's ideally how we want to invest. So on the next slide, it's essentially, it is the essence of how we invest in the core of the fund, which is the Pengana International Fund. So Jeff is going to mention in a while how the core fund, which is the Pengana International Fund, fits in with the Milliman methodology. But what I'm here to kind of present to you is the idea that already within the core fund, we aim for three things. One is to make money, which is why we're all here listening to this webcast and what we're all trying to achieve, essentially. But just as importantly for us is the minimizing volatility aim, and the third aim is minimizing drawdown risk, which means that when things get really tough, we want to try and limit that impact on the way down. Now, how do you do that? By being essentially fully invested in the markets. Well, the only way you can do that, in my opinion, is to make sure that you have the portfolio construction right, and you have the bottom up, the type of companies you invest in right. So if you buy the right companies and the right amount of the type of companies, then that will take care of itself. Okay, so from a portfolio construction point of view, we have sorry, there's a bit of noise on the other side. We have the majority of our money invested in what we call the core of the fund. Now, this was 15 years ago, prior to the GFC. So during this period, when I first took over some European portfolios managing money in Europe, my aim was to design a strategy and a way of investing so that it wouldn't change given the conditions in the overall market. So this strategy hasn't changed for the last 15 years. And what's good about it is it's quite common sense, but it requires a disciplined approach to how we implement it. So 60 to 80% of the fund's underlying holdings are in these stable and growing companies. We call them core investments. Think of this as your super tanker, if you like. So going from Sydney to London, you're going to hit some choppy seas, you're going to have calm seas, but the fact is you just want to get from here to there in a particular time, and you don't want to have too many interruptions. And these are the kind of companies we're investing in here. So these are companies that have been around for a long time. They've got great management teams. Their balance sheets, i.e. how much debt they have, is not very high, so we limit the amount of debt they have, so we limit the amount of risk. We've seen that over the last 5-10 years, how they've performed, how have they performed over crises, and we see that many of them benefit from a crisis. So a lot of our companies all of our companies here have the same attributes. They're growing 5 to 15%. They've got good balance sheets, good management teams, and they deliver a product or a service that the world needs now. They needed it 5 years ago, and they'll need it 5 and 10 years from now. So this gives us the stability of the fund. But then we say, okay, now and again, we look at the cycles. We will have a certain cycle, such as the oil cycle can drop, or let's say it's the banking cycle due to interest rates. So there you will be able to invest in that cycle at different times and different periods. So here we limit our exposure to this to 30%. It's zero if we don't find any cyclical opportunities. But here we say the risk is a bit higher, so we limit the exposure to these companies also in the amount we put into each individual stock. So here we do a lot more work in the cycle. So if we buy a fertilizer company, a lot of the work will be on the fertilizer cycle, and because that is driving the fundamentals of the business. The last bucket we invest in is opportunistic, which captures faster growing tech companies or companies that were once core businesses but had a one-off disruption. One example I can give you here is Novo Nordisk, which is the world's biggest insulin maker out of Denmark. Now, I've invested in this back during the thickest part of the GFC, and I've seen it grow over time. And there was disruption from the US in the sense that there was a lot of talk about pricing and excessive pricing in the US pharmaceutical space, and that hit the company where it fell 60%, where there was a lot of negative sentiment. We did the work. We waited for that. We knew it was a great company, but we knew that there was some disruption potentially in the short term. So we bought that business as an opportunistic stock, and we held it for 2 years, made sure that the situation stabilized, and then we moved it into the core. It's still with us 5 years later, and it's now almost doubled since we've invested in it. But to give you an idea, we respect the kind of risk we put on, which is why you have these 3 buckets. But during any type of market, bull market, bear market, flat market, volatile market, you'll always see this composition of the fund, and you'll always know what kind of risks we're taking. So given this mix of the type of companies that we invest in and the amount of these companies we invest in, we feel that we can provide a more consistent, or expect to have a more consistent return profile over time. On the next slide, we give you a snapshot, and I'm not sure if all of these numbers make sense to everyone, but this is, as a fund manager and as a CIO of the company, the way I see the 40 odd companies we invest in is I see it as one big conglomerate business. Think of it as, I don't know, think of a company like any Australian company that has 40 different divisions. And what we do is we buy companies in all different sectors. So we're not the kind of fund that'll put 20% or 30 or 40% in technology companies, because that's what everyone's doing, and because that's the sector that's doing well at the moment. We really aim to diversify. So within core, we have, as I mentioned before, companies that produce cork stoppers for wine bottles. We have companies that the biggest salmon farming company out of Norway. We have exchanges out of the US. We have Medtronic, which makes pacemakers and other medical devices. We have companies that produce lab equipment, and we have technology companies. So we combine all these because they all have different drivers. So even if we get something wrong from a top-down perspective, there's no cross correlation between the companies. Now, if we look at how cheap is the portfolio at the moment, what we use as a measure is we don't use PEs and all these other measures that people throw around, because you can manipulate earnings, accounting earnings. What you can't manipulate is how much cash flow a certain company produces. So the way we think is like industrialists. We say, if we buy a business, if we buy the equity and the debt, then we want to know how much cash, after we've paid for the lights to stay on, for the staff, for everything, how much cash is left over and is in my pocket. And that number divided by 100 is the percentage. And that is the divided by the total cost of buying the business is the percentage. So for us, it's 7%. So if you think of our companies, if they were to grow 10% a year at 7%, if we get 7 cents for every dollar that we invest in, over 15 odd years, 12 to 15 years, we'll get all of our money back. And we own the businesses then for free going forward. And we consider this to be a great investment, given that these companies are growing, and given the alternative, as Joy said, which is the cash rates and investing in bonds out there. So our revenues for all of our businesses on aggregate are growing 6% a year. We have hardly any debt, and in terms of cash flow generation, it's a very attractive price at this stage. So on the next slide, we want to get to, okay, so why do we have to worry about volatility? Can't we just take a view on the markets? Are they cheap? They're expensive? But the problem is, for example, this is a very great example and point in time on how confusing things can be. So at the moment, you've seen markets rebound so strongly, what people refer to as a V-shaped recovery. Now, we've had a V-shaped recovery in markets, but that doesn't mean that is reflected in the actual underlying economies of the various countries around the world. If we look at the US, we're about to hit the thickest, we've just had the worst quarter, yet markets are already up 30–40% since the bottom. And markets tend to anticipate a good outcome or a bad outcome. However, we need the economic reality to follow the markets. But what do we need in order for that to happen? Well, we need probably a vaccine. We need people to get back to work. We need people to be confident. We need people to be out there consuming, producing, as it was before COVID hit the world. Now, in order for that to happen, as I said, we need a vaccine. Now, there's so much talk of vaccines. There's so much data out there. A company will come out and say, we've got great data. Markets go up 3%. The next day, experts will come out and say that's not enough data. Actually, we can't say that it's actually working. Markets go down 1 or 2%. The point is, if we're going to make a big decision on how much money we put in based on the data that comes out of vaccine companies, we're going to have a very, very tough time. We could be very, very disappointed. For what it's worth, we believe the economic rebound will be more of a U-shaped recovery. It'll take time for things to get back to normal, people to get back to their old habits in terms of consuming, the companies to get back to previous capacity in terms of producing. That will take time. It's been the worst impact probably since the Great Depression. And this doesn't just resolve within a couple of quarters. And we think the market right now might be pricing in too much of an overly enthusiastic scenario and outcome. So, but there's people out there that are still saying, well, what about a second or third wave in terms of the virus hitting? What if the virus mutates? What if there's no vaccine ever? What do we do then? That could be a longer recessionary, kind of depressionary environment, which is also on the cards. So you've got these three scenarios. Scenario one's played out. We hope that it's true. But scenario two could be one where you will have much more volatility over the next 3 to 6 months, which would be something the market's not pricing in. And certainly scenario three is absolutely not priced in. Then we've got to think about the implications of the trillions of dollars pumped into the system. What happens? Well, if it is a V-shaped recovery, do we get a big inflationary resurgence in the markets? What implications does that have to interest rates? What does that mean for many sectors and jobs and what have you? So these are all the things from a macro perspective that there's many plates spinning up in the air. So what our fund tries to achieve by having invested in a bunch of companies across different sectors and across different countries that make products that the world absolutely needs through thick and thin, is to try to cut out a lot of this noise. In addition, sometimes even if you get all those companies right, if the weight of the market's falling, you cannot fight against that in certain situations, as we saw in the thick of the selling in March, which is why this product exists. This is where you need an automated system in a way that will immediately react to these kind of situations. And I'll leave it at this point to Jeff, our colleague in Milliman, to run through how the overlay takes care of the top-down kind of risk that is out there. So Jeff, over to you.
Thanks, Jordan. Hi, Jeff Gebler here, Head of Investment Solutions at Milliman. Can we just look over to the next slide, please? So I'll just give an overview of Milliman. Appreciate it's not a household name for many households. And my role is the Head of Investment Solutions. And what we mean by that is we are truly a solutions business. We are here to help our clients come up with the products and services that help them meet the needs of their customers. And this is why the relationship with Pengana works so well, is that we're not a business of stock pickers. We don't have views on all the different companies and valuations, but we are laser focused on risk. So what is Milliman? So more broadly, Milliman is a global actuarial consulting firm founded in 1947 in Seattle. It's since grown all over the globe with offices in most major cities. We got started in the financial markets over 20 years ago, helping very large international life insurance companies manage the market risks on their balance sheet. The industry had sold a lot of long-dated guaranteed equity exposure to their policyholders and didn't at the time have the systems or the people in place to manage those risks. So Milliman has been at the forefront of managing risk for financial institutions using the most liquid derivative assets that we can find. So at present, that covers about 200 billion of assets worldwide between investment advisory, hedging, and consulting. We have a very collaborative approach, and I'll talk later about how that works with the Pengana fund, and we're independent. So while we're one of the largest traders in futures and derivatives markets, we are an independent actor in the market. So we're not running proprietary trading or anything that conflicts with the needs of our clients. The practice that manages the risk for Pengana's fund and other clients is currently 185 people across the globe. So we have offices in Chicago, London, and then here in Sydney. And that's really important, especially as we've gone through the COVID crisis. You know, some other financial institutions are more siloed in how they've set up regional operations and offices, which means that they're not as tightly integrated as the risk moves around the world. So every single one of our trading books crosses from Chicago to Sydney to London every single day, which means that we have tons of redundancy if things go wrong. We were at the forefront, or I don't want to say the forefront, we were ahead of the curve in testing our plan for COVID. So before a lot of the globe started shutting down and going to remote work, we had already followed the steps in our disaster recovery plan to make sure everybody could work remotely from home. And so when the announcement came at a company-wide level to work remotely, we were already set up working at home, had all of our computer issues and things like that sorted out. So it's been a pretty smooth journey, except for you know, the challenges of working from home. So you know, we run a lot of very complex portfolios. It requires a great deal of computing infrastructure. We are experts in derivatives, in pretty much all manner of derivatives and risk management. So we're not here to speculate. We're not here to add alpha. We leave the alpha generation to Jordan and his team, and help deliver better outcomes. Over to the next slide, please. I'll just very briefly talk about what the fund is that we run for Pengana, the International Managed Risk Fund. What this fund is it holds predominantly units of the underlying international Pengana fund. And then we just have a small allocation to cash, and then inside that cash, we manage a futures trading algorithm that helps take out the risk. Next slide, please. So there's a lot of detail in this slide, but I think there's three core messages that I'd like to talk to here. This is, if we think about retirement in particular, now this fund is not just for retirees, but a lot of our thinking and a lot of the strategies that we've designed are tailor-made to folks that are nearing retirement or in retirement, and thinking about some of the risks that they face. I think it's one thing that is commonly overlooked is that not every investor gets the long-term return. When you have cash flows coming out of portfolios, you're negatively impacted even more by large drawdowns in the market. So you have to think about what we'd like to say is the liability of retirement, not just a long-term return focus. So the first point here is that because people are living longer than ever, they need more growth assets. And especially now that cash rates are low, as Joy alluded to earlier, bond rates are lower than they've ever been. There's more risk to the downside in bonds now than there is in the upside. If you think about how far can rates go, while they can go negative, there's a natural bound to how far rates can go, but it's anybody's guess how far rates can rise and subsequently bond prices can fall if we see a spike in inflation. So the assets that used to be safe are not as safe as they used to be. So that means that if you need returns, and people do need these returns, they have to look to growth assets to fund these longer retirements. There's a behavioral aspect of all this. So we know that when you run psychological surveys of people, the pleasure that people get from fear is much less than, the pleasure that people get from gaining or getting a positive return is less than the fear that they suffer from loss. So that means that if we wanted to construct an investment strategy to meet that behavioral aspect, we'd want to say, what if we gave up some of our upside in exchange for more protection on the downside? Knowing that 9 times out of 10 markets will go up. Most years the markets do rise, but sometimes you have a really bad year, and that can really negatively impact people in their lives. And then the final point is sequencing risk. So as I alluded to earlier, long-term returns are only valid for people that are buying and holding for a very long term. When you have withdrawals coming out of a cash, what it does is it impacts the portfolio disproportionately higher than that withdrawal. And so what the chart here is just showing that what happens to a portfolio, to the amount of income you can generate from a portfolio if you suffer a 30% fall in assets. So the key message there is that your greatest risk of sequencing risk is around the age 65. You're no longer contributing as much to your portfolio, and you're close to pulling assets out. And then as you get into retirement, that pattern continues. So for somebody that's 20 years old, sequencing risk is not a problem. For somebody that's 90 years old, it's also not as much of a problem because they don't expect to live as long. So if for somebody that's 65 now, if the market falls 30% or the portfolio falls 30%, that can take 13 years of income off of that portfolio. On the next slide, please. And there's a lot of detail, a lot going on this slide as well, but we know that market crashes happen. The last big one that we saw was in 2008, 51% fall in Aussie equities, and it did recover since then, but it took nearly 5 years to get there. If your portfolio falls 20%, you have to earn more than 20% back just to get back to where you started. So these really big falls are devastating to portfolios, and it's anybody's guess how long any of these market corrections will take to revert and get back to normal. The chart on the right, probably worth updating post-COVID, but what it shows is, the managing risk should give people a better outcome than if they sell at the bottom of the market, and that does happen. If you think about as the COVID crisis was playing out, there were a lot of headlines about superannuation funds scrambling to meet cash. So that liquidity need in superannuation was not a direct impact of the market falling. That was a result of the market falling and then people not trusting their funds and moving into cash. And once you lock in that negative impact, you've crystallized it. You're missing out on any of the gains that you might otherwise achieve had you stayed invested. Next slide, please. And one more. So what are, can you go back one slide, please? The strategies that we run for Pengana, it's rules based. What we're looking to do is manage volatility and attempt to give a cushion when there are market drawdowns. We recognize that retirees are different. You want a strategy that allows for the risks that retirees face. You need growth assets. Diversification can fail. So the underlying Pengana equity fund is an excellent fund, and it's performed extremely well. But when there's a major market sell-off, even quality assets take a hit. So this strategy is designed to hedge out some of that market beta exposure that even the best portfolio management can't always predict when everybody is looking to run to the sidelines and raise cash. And we think it should be explicit. So this strategy is it's a robust, transparent, cost-effective way to give risk management. Next slide, please. So what are we looking to do? We're looking to stabilize the portfolio around a target volatility of 12.5% per annum. We want to capture a lot of the upside. We're not going to get all of the upside, but we want to get most of it and cushion against sustained losses. We're running this around the clock. So whenever a market is open, somebody is watching the risk in this fund and potentially trading if they need to. This isn't a high frequency trading strategy, but if we need to trade as the market moves, we can. And it's institutional. So this is the same system and strategy that we would use to manage a multi-billion-dollar life insurance liability book, or for any one of our asset management mandates. It's predictable, and there's a global team that is looking after this. And as I alluded to earlier, the way that this is all set up is we have a fund structure which invests primarily in the underlying Pengana International Equity Fund, and then there's about 5 to 10% is held back as cash, and that cash is used to fund our futures trading positions. Next slide, please. And the two components are volatility management and what we call a put option replication strategy. So I might get a bit technical here, but hopefully it's easy enough to understand, and I can go into detail later if needed. One thing is that volatility tends to spike before markets fall. So we see this time and time again that markets are generally they track along at a certain level of variability day to day. As bad things start to happen, you see bigger swings in the market, and especially with the COVID crisis. So what have we seen? Unprecedented levels of daily volatility. So there was a period late March where if you woke up a day and saw that the market had moved less than 4%, that was a quiet day. We had multiple days where the markets were moving 5, 10%, and many of those big moves preceded some of the bigger drawdowns. So volatility management is designed to gradually shift some of the equity exposure out of the portfolio when markets get really hectic, when there's a greater chance for a major dislocation. The other part of the strategy is a put option replication. So one financial instrument that can be used to protect a portfolio is to purchase put options. So you can buy an option on the S&P or other market indices to protect from a large fall. But those options can be expensive. What we're doing here is we're replicating that put option with liquid futures contracts. And the point here is that this put replication strategy is exactly what the bank that's selling you an option is going to do, or if a life insurer is managing put options on their balance sheet, they're going to use a hedging strategy similar to what we do to manage that risk if they can't directly offset that with another option. Next slide, please. Again, a lot in this slide and quite a bit of detail here. The reason why we do replication is just because it saves money. We expect that on average, if we wanted to buy options continuously for a fund like this, we'd be dragging 2% more on average compared to what we should be doing now. The other thing too about using options is that they get the most expensive when you need it most. So had you timed the market perfectly, one could have bought options right before the crash and made quite a bit of money on that, and some people have. But let's say you just say, all right, going forward, I want to buy more options to protect the portfolio now that I've already taken profits from the prior one. Now the prices are more expensive than they've ever been. The VIX spiked to over 80%. It's now down below 30%. Volatility is very expensive right now. Now it was cheap before the crisis, but it's not anymore. So that the point there is that using options is really expensive sometimes when you need it the most. Next slide, please. So you know, the key features of the strategy here: smooths returns, cushions on the downside. It provides value by being a cost-effective way of delivering protection. Liquid, everything we're trading is liquid. There's no issue of counterparty risk because all the positions are collateralized daily. So there's cash moving around day to day as our hedges pay off. And that means that we can take comfort that we don't have any issues of a bank going bust or anything like that. It's predictable, so that means as we work with the portfolio managers at Pengana and other clients, we can test any number of scenarios and be certain that if that scenario plays out, our strategy will perform in line with what we expected. So there are no surprises when this plays out. And time tested. So the organization running this has been trading in the market since before 2000, been through a number of market crashes, and operationally has held up extremely well in every one of those situations. Next slide, please. And then next slide. So here's the key takeaway here is what has this fund done? So the combination of the portfolio management that Jordan's team does and our risk management overlay means that we've gotten a lot of the upside in the market since it's gone live, protected most of the fall, and then rebounded since then. So this shows how far ahead an investor would be from the start of the year till April being invested in this strategy, shown by the green line, compared to a diversified global equity portfolio. And then next slide, please. And then a bunch of numbers here. You know, the returns are stellar. The fund has outperformed the benchmark MSCI World since this year when markets have gone down. You know, overall, there's since inception it has lagged a bit, but that's because markets have done so well. So that's the cost of the protection and the cost of the certainty. Now, what is that? What do I mean when I say the protection? If you look at things like volatility, so how volatile is this strategy on a month-to-month or day-to-day basis? We're getting about half the volatility of the MSCI World of a broad equity index. So that means half the chance of big market surprises, half the amount of volatility that investors are going to see in their statements and thinking about, do I pull out now or do I sit tight? So you know, we will always say that for the investors that can stomach the volatility of the market, this is not the strategy for them. For the investors that might be the ones that look at the news in the morning and then sell out at the bottom, this is the right strategy for them. And then the maximum drawdowns. You know, since inception, the biggest peak to trough fall in our fund has been about 9%. The underlying equity benchmark, the MSCI World, has seen a peak to trough drawdown of close to 24%. So even though the market has rebounded, for people that are looking where they are and then where they were yesterday and where they are today, that maximum drawdown is a really important figure, and that's the thing we're trying to manage. Next slide, please. Next two slides. You know, I've covered a lot of this, but our investment decisions, we want to align with real world objectives and really give insightful analysis. So we're not here to push any particular strategy or product. We want to work with the portfolio managers to come up with something that works for them and be fully transparent about expectations of the strategy, what it'll do in different markets, what are the risks, and what's the value that it adds. We're giving our clients access to a global firm, which means they get access to trading teams around the world and markets across the world. And we believe everything that we do in our work more broadly should be transparent and predictable. Next slide, please. A bit more about us here, but I guess the differentiator between Milliman and other firms is that there's a lot of different disciplines that are brought together to make this all work. We have a number of actuaries, and they're really concerned about risk and liabilities, not necessarily focused on the investment side of things, but it's absolutely crucial. Folks that are involved in the capital markets, trade operations, and portfolio management, a large technology team supporting all the infrastructure. We have quants developing the models. Legal and compliance is really important. We go through audits everywhere. We'd like to say we're one of the most audited firms in the world. We always have auditors on site looking through our operational controls, the regulators looking at what we're doing. We're licensed in every market, which means that we're held to the highest standard across the board in every aspect of what we do. And then we support our clients with distribution and marketing. Next slide, please. A few more numbers here, just showing the scale of the trading that we're doing. 11 billion in futures, big players in ETF trading 14 billion there, 13 billion of interest rate swaps, and 20 billion of other options. We trade just about every derivative contract under the sun. We can manage most market risks that are tradable, and there's a system that supports this all that syncs up automatically with over 10 different futures brokers. So we can work with most trade counterparties to make these strategies work. And with that, I'll open it up to Q&A.
Thanks, Jeff, and then thanks very much. And thank you for the questions that are coming through. Ladies and gentlemen, really appreciate all of them. So I might just get started straight into them. It is really pleasing to see how the approach fared over the first quarter, even on the flagship fund. It's also done really well, but also the extra protection that we got through Milliman's approach. Jordan or Jeff, perhaps would investors need to forego some of the returns on the upside to enjoy this kind of downside protection?
Jeff, I think, talked a little bit about it, so maybe Jeff can flesh it out.
Hi, Joy. Sorry, my microphone cut out. Can you repeat the question?
No, that's okay. The question is really just about, it's really pleasing to see the extra protection applied on the downside. Do investors need to forego some of the upside return to enjoy that kind of protection?
Okay, maybe Jeff is struggling with the
Sorry,
mic. Okay, I'll come in there and answer the question. So this is Jordan speaking. So basically, if you look at the performance over the years, as Jeff put up on that slide, you can see we've had, as I said before, one of the strongest bull markets in a long time, and you've had very consistent returns over a long period, and actually a low volatility profile over a long period. So during this period, the Milliman risk protection program, if you like, was humming along in the background, and that means that it was buying protection. And as you know, you have house insurance, you have all these, when you buy insurance, it costs money. So in that kind of scenario, when markets go up, although we as fund managers do generate what we call alpha, which is outperformance versus the benchmark, there is always this cost associated with the protection to have it on across all markets. So yes, it's not guaranteed that the fund would underperform a strong market, but but we must be aware that there is an added cost. So everything else being equal, if we match the benchmark exactly with our stock picking and what have you, then the cost of the protection would mean that it would be a lower kind of performance over time. However, given that we are on the back of one of the strongest bull markets in history, and if I was to make a kind of not a prediction, but if I was to think about how the markets would develop over the next 3 to 5 years, as opposed to the last 3 to 5 years, given how highly valued markets are, we think that volatility will be much higher over the next 5 years versus the last 5 years, and the outcomes of where the markets go for the next 3 to 5 years are not as simple as they were in the past. A lot of the it makes sense to have this added protection if we do see this increased volatility regime in the markets over the next 3 to 5 years.
Thanks, Jordan. Jeff, do I still have you on the line just to check?
Yes, just had a technical difficulty there. Jordan,
that's okay.
That's the answer.
This is another question. I've got another 2 questions for you. So just on that, during a bear market, I'm assuming we're not really sure. So is the approach automatic, and is there a lag when it comes to protection kicking in?
It is automatic. and so is there a lag? So the the one fact of the strategy is if all the signals are saying the market is benign and we have a 30-40% sell-off in the market tomorrow, we're not going to protect that. But the response to that, though, is that you can't protect for that unless you always buy very expensive option protection right before that happens. So what we can protect for is volatile markets and volatile falling markets. So yeah, there is a time that it takes to adjust the strategy to kick in, but we run this over a lot of different scenarios, a lot of different distributions, classic models, historical scenarios, and what we feel that we have now is the right balance of kicking in to get protection without taking away too much upside.
And can you just explain a little bit more on that maximum drawdown period we saw in those tables earlier in the presentation, and just maybe explain that period itself and what happened?
Yeah, let me bring that up here. So yeah, I mean, as the market started falling, the volatility signal kicked up, the hedges kicked in, and that protected a lot of the fall. And then as the volatility subsided a bit, protection unwound. We're now sitting at about 25% protected, so we're getting most of the upside. But if there is a fall, 25% will be protected, and then gradually protected. The maximum drawdown, so that's from the very peak to the bottom, measured over any number of periods. So it meant that the fall that we saw in the fund, if you're looking at daily unit prices, was no greater than a 10% drop compared to a 23% drop in the benchmark.
I'm just going to, Jeff, it's cutting in and out. I'm just going to summarize a little bit. Basically, the market, the fund right now, as Jeff said, is about 25% hedged, which means what? If the market was to go down 10% tomorrow in one day, 2.5% would be absolute. It would be hedged, and then it would be up to the rest of the portfolio and what I talked about before on dealing with such a fall. However, if there was a fall in the market tomorrow, followed by another one the day after, and up again and down again, volatility would increase, and the hedging or the protection would increase over that period as well. So as bear markets really just drop 60%, and then off we go on the upside. They tend to, these bear markets tend to form over time, and they tend to fall, and there's a bit of optimism, then fall again, and so through an increase in volatility, markets tend to fall over time. And this strategy is designed to capture that kind of market fall if it does happen. Otherwise, if we just stay around the same point with a lot of volatility, it'll have a certain amount of protection, but it'll be up to us again to pick the right companies. And given that we are buying growing quality businesses, we should over time outperform even such a flat volatile market.
Thanks, Jordan. And this is another question here for you while you're there. Just on the managed risk fund, not necessarily always keeping up with the upside. Do you see, is there a minimum asset base that you need for the fund to remain open and sustainable?
So the two questions are kind of not related, I guess, not keeping up with the upside. Well, that's basically the way we see it. It's designed to basically capture as much of the upside as possible. And as I said before in my long explanation, sometimes it'll beat an upward market, but there is a drag from the protection. But the second question is in terms of sustainability of such a strategy. Well, although interest in such a product has waned, obviously during the biggest bull market in history, which we've just witnessed, with very low volatility, if you were to go to someone and present what we've been saying for the last 40 minutes and say, look, you should think about volatility, you should think about what happens if markets go down, what will you do? It's been a buy the dip market for many years now, then the interest wouldn't have been that high. But I think the last 6 years, if anything, were the exception to the rule. I think if you were to look at the structure of markets and how they should behave, there should be more volatility, and there should be more, and a more uncertain path towards a higher number down the line. And because of that, and given where we are now on the back of a big bull market, we think this kind of strategy makes a lot of sense. Adding to the fact that what Jeff said, many retirees have these added kind of considerations to think about. We think this strategy is now optimally positioned for the next 5 years. Again, if you include the fact that we think volatility will increase. Having said that, we've had 4 years of history with this fund and us working with Milliman. We think it takes time to show the market how it functions. This is we are starting to put the word out there. People are starting to recognize the benefits of a managed risk strategy going forward. So we're anticipating an interesting period over the next 3 to 5 years with this particular product, should markets develop the way we think.
Okay, thanks, Jordan. And just a few minutes left, and I might just shift this off very quickly towards some of the positions you're looking at the moment. Jordan, are you taking any capitalizing on any of the stay-at-home trend style stocks?
Oh God, that would be a great conversation if I had 1 or 2 of them, to say, yeah, we bought Peloton, people are riding bikes and it's really great, we were so smart. But that's not how we function. The way we function is we don't buy for whatever's happening right in front of us. I like skiing, and once upon a time my instructor said, don't look at the tips of your skis, look where you want to be heading. And that's kind of the philosophy on how we invest. So if we just keep executing and keep buying the great businesses that we're buying and hold them for long enough, they're growing, they've got great management teams, we're very confident that we'll have quite a predictable outcome of solid returns and less volatility. Now, talking about this crisis in particular, what we've had is even more, what's very important, and I encourage all of our clients to look into their portfolios, is how much of your fund manager's underlying risk is centered around the US markets in particular, and within that, the tech sector. Looking overnight and looking at the last 6 months to 10 years, the technology sector in the US in particular, the large cap companies and the payment companies like Visa, they've driven primarily the returns of the US market, and more people are crowding into the same names. If you look at our portfolio, we've got about 2 or 3% in the US tech sector, and we've had that for a while. And although that's where all the returns have come from, we've managed to actually find companies outside of that one particular place by owning Indian Tower, the telecom towers, by owning all these other kind of businesses, and we'll continue to do that. So our process must be repeatable. We shouldn't need a COVID situation or a bull market in a particular sector to allow us to do well. We need to be able to repeat the process in whatever condition we're faced with.
Thanks, Jordan. I think one of the panelists that are on the call today, Ryan, could be with us, one of the analysts from our team. Now, I'm going to have to ask this question. It's one of the popular ones around central banks at the moment. Ryan, if you're there, is the sugar hit starting to wear off? Okay, Jordan, you might have to fill in for Ryan.
I'm talking about sugar hits, am I?
No, sugar hits of the central banks.
Okay. Yeah, I just want to be clear on which sugar hit with, but yeah, look, the central banks have been at it for many years now, and started with Greenspan following the .com bust, and it's been keeping markets ticking up, ever since then. So basically what happens is, if your alternative, as you put the first slide you put up, if your alternative is to put your money in a bank or put your money in a bond, and you're getting 1%, or in Europe you're getting negative 0.5%, you're paying the bank to keep your money. That is not a great investment strategy for the long term. So then you're looking at the markets and you're saying, hey, in a normal market I would expect to see my money back in, say, 15 years, but now given the alternatives, I'm prepared to go to 20, 25 years, which is why a company like Apple will just get more and more expensive. When we bought Apple, it was our biggest position 5 years ago. It's now more than doubled. We've sold it, but we bought it at 6-7% free cash yield, and we sold it at 4%. It's now around. It's hardly grown during that period. So the fact is, things just got more expensive because of the lack of alternative asset class to invest in. Now, given what the central banks around the world have done, it's been unprecedented. The amount of money that's been pumped into the system, you've got to think how it's clearly flowing into the markets, and you're seeing that response now, and that's why markets are doing well, and there could be more to come. But the fact is, many companies are now, especially in the US, are quite expensive. So for these companies to keep going up, you're going to need more and more of this, as you put, sugar high to continue. In addition, though, now you've had governments join the fray, and you've had governments injecting tons of, trillions and trillions of dollars. In the US, it's been trillions of dollars added to the economy. Australia's added some. Europe's adding another $500 billion they've just approved. So this is a big amount of money, and you've got to wonder, how does this all find its way into the underlying economy, the system, and what happens to it? Does it just disappear? Do some people just get wealthy, the others get poorer? So there's a lot of money in the system. It's finding its way into the markets, obviously. The question is, let's say we do get a vaccine. Let's say everything does go back to normal as the markets predict. What happens to inflation? Does all this money force inflation into the system going forward? That's something you've got to think about. How do these governments eventually pay back all this debt? How do they, all the future generations that have paid for, all these problems? How does that work out over time? All the debt that's out there in the US. So these are very complex problems. But the short answer to your question is there's a lot of money out of there, and it's certainly helping markets. When does it end? It's anyone's guess. They've reached
add it to the list. Add it to the list of unpredictability. Fair enough. So thanks very much. I'm going to wrap this up here, ladies and gentlemen. Thank you for your questions. There is a little bit of follow-up, so be in contact with those that we didn't get the answer to. Now, if you have any more, feel free to contact me directly or a member of the distribution team. And we look forward to speaking with you all again soon. Thanks, Jeff, and thanks, Jordan, so much for your contribution.
Thank you, everyone.